Hello again, class. This is Dr. L, and I am going to go over the odd questions for Fin 3400 from the Fundamentals of Corporate Finance text, 3rd edition. Let's begin. So, Chapter 6, we're still dealing with future value, a little bit of present value, and some annuities also. So, the first question reads future value with multiple cash flows. Conerco Inc. expects to return cash flows of 13,227, 15,611, 18,970, and 19,114 over the next 4 years. If the company uses an 8% discount rate, what is the future value of these cash flows at the end of year 4? All right, so let's identify the given. We have the years, right? We have years 1, 2, 3, and 4. So the bottom line is we have the discount rate of 8%, and we need to find out what the future value of the cash flows are at the end of year 4. All right, so the first step is to find the net present value at year 0. And if you follow the net present value formula from your text, you'll know that the net present value is going to equal, and again, this is the formula written out in kind of like a sentence. It's going to equal the rate, then the values of the cash flows, which is given above. And that's it. That's all you really do. So let's go ahead and do it. So to find out the net present value, what you do is you press equals NPV, and then you click on the rate, and then you literally just do click on the cash flow for year 1, comma, year 2, comma, year 3, comma, year 4, and then that gives you $54,739.50, but we're not done yet. The second step is to find the future value at the end of the 4th year. So now we have to use the future value formula for this, and the future value, as discussed in the previous video, is the rate, comma, number of periods, comma, you enter 0 for payment, and then use a negative present value, okay? Because it's, again, money out. Talked about that. So what we do is we press equals, FV for future value, open parentheses, and then for rate, we're going to click on the 8% because that's our discount rate, comma. The number of periods is going to be 4, okay? Then for payment, we're going to enter 0 because the question is not applicable, or you can even erase the 0 and just leave a blank space for these particular type of questions. And then the present value is you got to put a negative in front of it, but then you put negative, and then this one, the 54K, and then you end up getting $74,472.48 as the answer for 6.1. So now let's move on to 6.3, future value with multiple cash flows. You are a freshman in college and you're planning a trip to Europe when you graduate from college at the end of 4 years. You plan to save the following amounts annually starting today: 625, 700, 700, and 750. If the account pays 7.75% annually, how much will you have at the end of 4 years? So let's check. The first thing that we do is identify the given. We have our years, right? There's a key phrase here that you have to look out for when you're doing your homework or when you're taking the test. It says starting today. So this means that it's money out year 0, 625, not after the first year, then you pay 625. And that matters. That makes a very big difference in how you approach the problem. All right. So year 0, you're out 625. Year 1, 700. Year 2, 700. Year 3, 750. Okay. So now that we've identified the given, first thing that we need to do is to calculate the net present value at year 0. So in order to calculate the net present value, we do equal NPV, and then our rate is going to be the discount rate, the only rate that's given in the problem, and then the value of the cash flows. We have to take the values of the year, the first year through the 3rd year, and then we have to add in our year 0, okay? And that's what you have to do in order to get the net present value for a question that's comparable to this one. So just remember that. So once you have the net present value, we can go ahead and move forward and find out the future value at the end of year 4. All right. One tip that I can give you is to use 4 as the period. All right. Um, because where does it say this? Here we go. How much will you have at the end of 4 years? So that's important that you note that. So year 0 doesn't really count as it's from year 0 to the first, it's a year hop, then a second, then a third, and then at the end of the 4th year, that's a 4th year hop, right? So that's why you want to use 4. So we do equal FV. The rate is gonna be 5.75. And then you have the number of periods, which is 4. Remember we said 4, so I just typed it in. For payment, we put 0 because that doesn't apply to this kind of problem. And then for the present value, we do negative and then negative net present value, okay, because it's money out. And then you get your answer, which is $3,185.40. All right, moving on to 6.5, present value with multiple cash flows. Jeremy borrowed some money from his friends and promised to repay him the amounts of 1,225, 1,350, 1,500, 1,600, and 1,600 over the next 5 years. If the friend normally discounts investment cash flows at 8% annually, how much did Jeremy borrow? So guess what the first step is going to be is to identify the given. So we have annual payments. First year, we have the 1225, second year, the 1350, third year, the 1500, fourth year, the 1600, and fifth year, the 1600. Okay, 5 years. That's why we have this here. Discount rate 8%. That's what we know from the problem so far. So the bottom line is how much did Jeremy borrow? And in order to find out that or any other comparable problems, we need to find the net present value. That's it. So not very complicated. You do equal NPV, and let me zoom in. Right, you do equal NPV. For the rate, you put in the 8%, and for value 1, value 2, value 3, value 4, value 5, you just click on each one of these individually. So 1225, comma 1350, comma 1500, comma 1600, comma 1600, comma, and then you end up with your answer, which is net present value of $5,747.40. Okay. Now let's move on to problem 6.7, present value of an ordinary annuity. And if you had read your text, you would know that there's a difference between an ordinary annuity and an annuity due. So if you have not read it, you probably should stop and read that because that's gonna play a role in how you execute these problems. So present value of an ordinary annuity. An investment opportunity requires a payment of $750 for 12 years, starting a year from today. If your required rate of return is 8%, what is the value of the investment to you today? So given is we have annual payments of $750, the number of payments is 12, and required rate of return is 8%. So all we need to do is just find the PV, the present value, and we know that the present value equals the rate, comma, number of periods, comma, and the amount of the payment. So if you remember from previous videos, we didn't really use payment in many other problems, but here we are. So we have this here, payment. It's telling us specifically, so you want to be able to flag for those things. So present value equals, and then we do the rate, which is 8%. The number of periods is 12, comma. The payment is 750, and that's it. That's all you need. Here we actually did use payment within the formula because we're dealing with annuities and we're given payment specifically. So that's something that you want to keep in mind as you work on these problems, okay? All right, so 6.9, future value of an ordinary annuity. Robert Hobbs plans to invest $25,000 a year at the end of each year for the next 7 years in an investment that'll pay him a rate of return of 11.4%. How much money will Robert have at the end of 7 years? Step 1, isolate the given. We have okay, I need to rework on that. So we'll revisit this one at in a different problem. So hold that thought. Now let's hop on to normally we would now I know why I skipped this one. So normally I would do the odds only, but question 6.11 is tied to question 6.10. So I didn't really think it was fair to do 11 without doing 10, which is why I skipped 9. Now it's coming back to me. Okay, so let's do 10, 6.10. The one of the few even ones that you're gonna get in this form. Future value of an ordinary annuity. Cecilia Thomas is a sales executive at a Baltimore firm. She's 25 years old and plans to invest $3,000 every year in an IRA account. At the beginning of this year until she turns 65, if the IRA investment will earn 9.75% annually, how much will she have in 40 years when she turns 65? Okay, so the given is the annual investment plan is 3,000. Her current age is 25, the retirement age is 65, and the rate of return is 9.75. So the first step is really to figure out how many deposits are gonna be made. Typo. Being. Okay. So in total, there's gonna be 40 deposits. Why? Because the retirement age is 65. Well, we're being told that the age at which she's retiring is 65. Her current age is 25, so there's a difference of 40. So 40 deposits, and this is going to be important for calculating the future value formula because this is going to be the number of periods. So the second step is just simply to find the future value, and when we do it, okay, so then the future value we put equals FV open parentheses. The rate, we have it, 9.75, comma. The number of periods is not any of these, it's this one, 40 deposits, comma. And then the payments, they're going to be negative 3,000. Why? Because for her, it's money out each year. And that gives us a future value of 1,240,676 and 41 cents. And now we have what we need to solve for problem 6.11. And now this one is talking to us about an annuity due, which is not the same thing as an ordinary annuity. So refer to problem 6.10. Okay, we did it. If Cecilia invests at the beginning of each year, how much will she save at age 65? All right, so here's an easy method. You can complicate yourself all you want with Excel, but I like shortcuts. I'm pretty sure you like shortcuts too. So if you look at the bottom of page 181 in your text, you will see that the formula for annuity due equals the ordinary annuity value times, and then in parentheses, 1 plus the rate. That's it. We have annuity due from the previous answer, and we also have the interest, so why not just use that, right? So the annuity value from the previous answer was 1,240,676 and 41 cents, right? Yes, we got it from here. The interest was 9.75%, right? We got that from here. So all we're really doing here is just following this formula. The ordinary annuity value, which is this, times 1 plus the rate. And when you do that, see, I did the annuity value times, and in parentheses 1 plus the rate, we get 1,361,642 and 36 cents. And if we confirm with the back of the book, we got it. So now we can move on to problem 6.13, computing annuity payment. Now we're talking about payments. So now that we are talking about payments, we're going to be using that PMT section of the FV and the PV formulas that we're using in Excel. The Elk Ridge Bar and Grill has a 7-year loan of $23,500 with Bank of America. It plans to repay the loan in 7 equal installments starting today. This is an important word when you're looking at your problems. Starting today. If the rate of interest is 8.4%. I haven't had enough coffee today. How much will each payment be? So let's unhide this. We have the given, the loan amount is 23,500. The number of payments is 7 and the interest rate is 8.4%. So now we solve. The only thing that we have to do is calculate the payment. And thankfully Excel has a PMT formula, which is just like one of the sections of the business analyst calculator, the BA2 plus. And if you look across, you'll see that it has a N, an I/Y, PV. So that fourth key on the business analyst calculator is the PMT, and then FV is right next to it. But here in Excel, we're gonna use a formula. So what is the formula asking us for? We put equal PMT. The rate, we have it, which is 8.4. The number of periods is 7. The present value is 23,500. The future value is going to be 0. Why 0? Because that's going to be your balance when you pay it in full. All right? That's why. And then type. This is very important. Type means that if you put a 1 as type, it's just kind of like an Excel code. That just means that it's at the beginning of the period. If you leave it blank or if you put a 0, it's going to automatically default to the end of the period, right? So when you do it, like so, you'll get $4,221.07. And that's how much each payment will be. Okay, and if you confirm with the back of the book, that's correct. Next, 6.15, perpetuity. Calculate the annual cash flows for each of the following investments. 3-part question, right? Not that hard. A, 250K invested at 6%. B, 50,000 invested at 12%. C, 100,000 invested at 10%. We're not given a whole lot of clues here, right? That's because there isn't really much to think about. We have the present value. We're solving for A. Present value 250K. The interest 6. All you do is just multiply the 2. That's it. All right, second part. B, present value 50,000, interest 12%, payment 6,000. Lastly, let's unhide this. Part C, present value 100,000, interest 10%, and the payment $10,000. That's it. So these are annual cash flows. So then these are at the end of each year. So then that's the payment due. Okay. So again, a very simple question. Just it's kind of like it kind of throws you off because a lot of the other questions required a lot more involvement. Next, 6.17, effective annual rate. Cyclone Rentals borrowed $15,550 from a bank for 3 years. If the quoted rate, APR, you've heard of that before, right? APR, is 6.75%, and the compounding is daily. Daily is a key word. What is the effective annual interest rate? So what's given? The term of the loan is 3 years. The interest rate, or the APR, is 6.75, and the compounding frequency per year is 365 days. Why? Because it's compounding daily. There's 365 days in a year. Okay. So step 1 is to find the formula for EAR, year, in the book. And guess what? There's also an Excel formula for that, and it's called effect, equal effect, and that gives us the effective annual interest rate. So you just do equal effect See, and then you're able to start calculating it, to input your variables. So the second step is just to solve, right? EAR, we know what the formula is because we found it in the book. And when we do equal effect, open parentheses, all you do is you select your nominal rate, which is 6.75%, and then the number of periods, which is 365. Now, what did this question do? Well, the back of the book says that this is actually 7%, but you put 7%, 7.0, 6.98, 6.8, it doesn't matter to me. As long as you get close and you show me how to do it, I need to see that you're able to do equal effect. That's all that matters to me. So guess what? This question gave you additional information that you didn't need to know, right? We didn't use term of the loan, did we? So it doesn't matter how many years. It could be 1,000 years. It doesn't matter because the you're given the annual percentage rate anyways. So within that annum, within that year, you know that the compounding is daily, and that's all you really need to know to solve for effective annual rate. And now that you know how to how to calculate EAR, you can go ahead and do that for the rest of your problems. This concludes the video Excel tips for Chapter 6 from the end of the book of the Fundamentals of Corporate Finance text, 3rd edition. Again, if you have any questions, comments, or concerns, please feel free to contact me and I'll be more than happy to assist. Have a great day.